Welcome everyone to our first episode of Home Point Elevate, a new live event series for originators where it's our goal to bring you the latest in mortgage industry trends and pro tips to help you improve your business. We're recording today's event. Thanks for joining us. We've got some great content and insights for you all. We're going to push out a copy of that recording tomorrow to all of you. So keep in mind that you can submit questions throughout our chat, throughout our event. Do not use the chat window. Please use the Q&A section, and we will get to your questions. We're very excited to get your feedback. We will have a portion at the end of our discussion where we take questions, but you can submit them throughout. Just be sure to use the Q&A. So I'm going to summarize what we're going to focus on today. There's no question we're in the middle of a booming market. I think that my term is supernova. It's a supernova instead of a refi boom, right? We're seeing purchase applications up 30% and refis up 51% year over year. Loan officers are working longer and harder than ever to keep up with the pipeline. Home prices are rising and homeowners are sitting on record amount of tappable equity in their homes. The opportunity right now seems limitless, and it requires a ton of focus and energy simply to manage the influx of customer demand while staying on top of record pipelines. But if this year has taught us anything, it's taught us that things can change in an instant. So we need to challenge ourselves to plan for the next market and invest in the things that will make us stronger in a much different environment. Today, we're going to dig into the latest projections for the economy and housing market and discuss what it actually means for brokers. LOs are busier than ever right now, but I know that you want to be sure that you're working harder, not just harder, but smarter. The decisions that you make today will determine the success of your business for years to come. So I'm Will Pendleton. I'm currently the Senior Managing Director of Third-Party Originations at Home Point Financial. I've been focused on building mortgage production across all production channels for over 15 years. I have the pleasure of leading a tremendously talented team that really cares about our customers and fellow associates. At Home Point, our pure focus centers on building the best platform for brokers and correspondents. And over the past 24 months, we've increased our monthly production in TPO and wholesale from $400 million a month to over $4 billion. So we've been blessed by the trust that our customers have given us. And we're also on the right side of the growth and the explosive growth that we've seen in the wholesale channel. And we're very thankful for all of that. So I'm pleased to introduce two experts that have joined us today who are going to help us talk about the market and think about what it means for originators. We're also going to dive into what we can do to prepare for what's on the other side of the current market that we're in. Welcome to Len and Shelby. Welcome, guys. Thanks for joining us. Hey, guys.
Hey, great to be here.
Thank you. Len Kiefer is Deputy Chief Economist at Freddie Mac. Len, I've been a big fan of your visualizations over the past couple of years. I've been following you on LinkedIn. I'm really happy to have you join our discussion today. Can you tell us a little bit about yourself?
Yeah, sure. Thanks. Glad to be here. So I'm an economist at Freddie Mac. I work in our economic and housing research group, which reports up to our chief economist. So we try to help people understand what's going on in the economy, housing, and mortgage markets. And obviously this year has kept us extra busy given all of the big developments there with the pandemic, the refi boom, mortgage markets going through a lot of volatility. And so a lot of folks have been asking me to talk about what we see going on, what's the trends. I got a great team back at Freddie Mac that helps us to analyze the trends in the market, what's going on with the economy broadly, and then narrow it down to the mortgage market. Happy to be here and share with you all some of the things that we're seeing, some of the research that we're doing as it relates to the housing and mortgage market.
Thanks, Len. Really appreciate it. Can't wait to dive into some of the insights that you have to share today. So Shelby Elias is CEO and founder and partner of United Wholesale Lending, an independent broker based in Sacramento, California. Shelby and I had the pleasure of meeting last year, and I was immediately impressed by the scale and efficiency of his organization, but even more so about his forward-thinking nature and leadership instincts. So Shelby, can you tell us a little bit about yourself and your organization?
Sure. My name is Shelby Elias. I'm CEO of United Wholesale Lending. We have a little over 100 staff members that work throughout Northern California, and we focus on broker business, realtor business. We have a heavy hold on purchase. So although we're in a refi boom right now, we're still trying to hold true to our roots. And we focus on trying to create an Amazon-like experience for all of our customers.
That's fantastic. Yeah, I do want to dive into, just how important it is to focus on purchase and those purchase relationships, despite the influx of demand. I think that's one of the most impactful things that you can share with us. So thanks for joining us, guys. So let's kick it off with Len and some of the latest headlines in the economy and housing. Freddie just reported another record low 30-year mortgage rate, as we all know. So the first question is the one in which we've kind of gained everyone's interest. How long do we think this market is going to persist? So Len,
yeah,
I'll pass that one to you.
Yeah, that's a great question. When they ask me sort of what's the projection, a lot of it boils down to mortgage rates, because housing is just so sensitive to those rates, and the fact that we've had record low rates. I've lost track of the number of weeks where we broke, to a new 50-year low in the United States in mortgage rates, but many times this week, and that's created a tremendous opportunity. Both on the refi side immediately, but also on the purchase side, also helped support that market, which has come back very strong over the last couple of months, despite the enormous challenges in the broader economy. If we look at the trend in mortgage rate, which I got this sort of fancy chart here up on the screen there, that's showing the mortgage rate trend over on the left panel. The black line is sort of where mortgage rates have been over the last, 20 years, and they've been mostly headed down, right? We've just seen, rates decline pretty much year over year, about 2 percentage points a decade. I got this fancy color on here to give us some perspective on how they've moved over time, because that's very important for the refi market. So the blue is looking back over time, where were rates the highest over the last 3 years. So if you're right now, the highest they were in the last 3 years was back in the fall of 2018, when they got almost up to 5% in our survey. So 5% mortgage rate. We're now 2.87 this week, a big drop of about 2 percentage points. So it's not only the fact that rates are super low, it's that recently they were a lot higher, almost 2 percentage points higher. That creates a lot of potential refinance borrowers, creates a lot of tailwind on the market, and that's why we're seeing, such strong volume in terms of refinance applications, refinance demand, on top of a purchase market that is coming back. Key question is, how long can it last? And the honest answer is we don't really know, right? Economists try to forecast interest rates, but it's very, very difficult. Over this period, 20 years, economists have been saying pretty much every year that rates were likely going to head higher. And there were a couple of years where they did head higher, but for the most part, rates have fallen. Can we depend on mortgage rates to fall another 2 percentage points over the next decade? I'm not so sure about that. But what I am pretty confident in is that rates are going to remain low over, the next couple of years, right? I mean, the economy is just going to take a long time to mend fully. The Federal Reserve is keeping their interest, their policy rate very low, and forward-looking projections on where the market may be headed, and the financial markets are agreeing that rates are likely going to stay pretty low. Maybe not at record lows, maybe they creep up a little bit, but pretty low over the next couple of years. But even in that world, if rates, creep up to around, let's say, 3% over the next 2 years, you're going to run out of refinance because folks are going to burn out. You're going to sort of exhaust that potential. So I would anticipate in that type of a world that what we're going to see is refinance volumes come down. And if rates were to spike, they'd come down a lot quicker, which we can talk about some of that history there. But one thing to keep in mind is there's still some room for rates to drop, even if broader, treasury yields don't fall. The mortgage interest rate relative to benchmark sort of treasury yields is a little bit high relative to historic spreads. And so if those spreads were to narrow, which they, I think, are gradually are doing, then you could get a 30-year mortgage rate around 2.5%. And so while that's not our baseline forecast, that's a very real possibility that over the next year, even if broad treasuries remain flat, mortgage rates could drift down a little bit. But down a little bit, up a little bit. I think that's kind of the world we're in. Relatively flat mortgage rates is what I would expect, with a caveat that we never get this right, and there's a lot of uncertainty. It can go either or way with a pretty high chance of that.
So Shelby, what's your reaction to the forecast? I mean, I think Len covered a lot in that, right? The potential for rates to even push lower is there. The likelihood that this low rate environment, historically low rate environment, persists for an even longer period of time is there as well. So how do you feel about that aspect?
Well, hearing that, I mean, that's great news. That's exactly what I want to hear. But, you know, what our initial reaction was is let's go out and get as many refinances as we possibly can. Let's call all of our past clients. Let's shout from the rooftops and let everyone know that right now is the time to refinance. Mm-hmm. What we started to experience was not being able to keep up with the volume that we're getting in. So then we were like, hold on, maybe not reach out to everybody. Let's kind of mellow it out because clients are getting upset. So, you know, right now we're learning how to manage it. We're hiring, staffing up. We're learning to compartmentalize the job duties for the loan officers. That way they have less on their plate. They can still maintain the service. But most importantly, we all need to realize that this is a marathon. It's not a sprint. I know we've heard that before. You want to avoid from getting burned out. You want to avoid, you know, really pissing off your past clients that you worked so hard to keep those relationships over the years. And then, you know, time like this, you don't get back to people. You're not returning the call. People feel like too busy for them. So it's a marathon. It's not a sprint. Good news for all of us, though. I mean, it's great.
Yeah, absolutely. And I think we should dive deeper into the personal implications and the things that we're doing to help the support side of this, but we can cover that in the later part of this discussion. Let's go back to more of the forecasting. Len, I think we have some more of your imagery to pull up so that we can get a better taste for different aspects of the market. Here we're looking at historicals. I'll let you kind of take that away.
Yeah, absolutely. So this is our Q2 forecast. We're putting the final touches on our Q3 forecast, but the history, of course, is the same. The forecast might be a little bit higher for 2020 volumes, but the basic story holds for this. And there's a lot going on. So the green bars here are home purchase mortgage originations in dollars, trillions. So we did about 1.3 trillion last year of purchase, overall market, about 1.1 trillion of refi. And so you look forward into 2020, we're talking around $2 trillion in total refinance originations. And maybe if volumes continue to run strong in the third quarter, could maybe 2.5, which would be, you know, a record in nominal terms by far. And so just incredibly strong refinance volumes. I know Freddie's, you know, our single family business has seen some record volumes in the late summer. And it looks like it's continuing into the early, well, we're almost in fall, depending on, you know, where you are. A little chilly here in Virginia a couple of days ago. And purchase market, though, of course, taking a little bit of a hit because of the coronavirus pandemic and the fact that the spring home sales season really got derailed. Now, the market's come bouncing back very strong, but I think on aggregate, we're probably going to be down a little bit in terms of total home sales this year, just because, you know, we lost 2 months of the busiest season of the year. But then looking forward, we're expecting and anticipating pretty solid growth on the home sales side. And when you couple that with strong house price growth, that gets you origination dollar volumes up around 20% in 2021. But that by itself won't offset the decline in refi. So you think about the volume is likely going to shrink. And this is where the history is, I think, instructive. Because if you go back just to 2018 or 2014, you can see those bars on there. You see the blue shrinks quite a lot. And those are periods where rates didn't rise a lot. You know, they got up around 5%, which is still, from a historic perspective, a super low mortgage rate. But you saw refinance volumes in 2018 tail off, and again in 2014. So if you're thinking about your business mix, you know, it doesn't take much to see volumes contract pretty significantly on the refi side. The purchase is a little more steady. You can kind of see over from 2012 up through 2019, we're seeing this steady sort of gradual growth in those green bars. As we look at the broader market and think about the fundamentals of housing demand, there's a millennial generation that's going to provide a lot of new buyers in the marketplace over the next, you know, 3 to 5 years. So that steady incremental growth with a lot of volatility coming from the refi market. And so that's sort of our how we think about things. I've been optimistic about the broader housing market because of some of those fundamentals of demand on the purchase side. But I got to watch out for, and it doesn't take much to see that volume swing a lot, and you can see that in 2014 and again in 2018 in the bars here.
Yeah, absolutely. And if you look back, if you can leave the chart up, if you look back to those years that you referenced, doesn't take much of a rate move, and you can see the significant volume dip right in the
Yep.
refi in the blue. So that's the real aspect that we have to take away from this, right? We have strong purchase fundamentals, so 2021 is looking good. If you look at it historically across this chart, still the total volume opportunity is going to be a really healthy number. But the decline, of 400 million is significant, right? That's going to be a significant decline in industry capacity. So that's something to note. And then, we're along with that forecast, correct me if I'm wrong, but you're still anticipating, or a part of that forecast that's driving the 1.3 number is low rate environment persists, right? So.
Yeah, absolutely. Our forecast is basically has rates flat. And so, you'll get some laggards coming in, folks that sort of haven't quite realized that rates are at record lows, or maybe they were just slow to respond. They'll sort of be there, especially that's front loaded too. So a lot of that volume would be in the first half of 2021. And if rates are flat, you're going to be.
Yeah, that's great insight. I know it seems crazy to look ahead to 2022, but I do think there's almost a little bit of a benchmark, not maybe to this degree, but if you look back at 2012 and 2013, we had 2.6 trillion worth of refis in back-to-back years combined, right? Yep. Then you look at what happened in 2014. I think that's what we have to contend with on the backside of this market, right? When rates start to increase, we're going to see a significant dip, right? And so what I do want to engage in is a little bit of that planning discussion to say, don't forget about the purchase relationships. We've got to continue to nurture those, and we've got to continue to know that when refi turns off, the purchase is always going to be there. So we can't forget about the nurturing and the energy and the effort that it takes to kind of maintain that business, maintain those relationships, right? Shelby, I know you guys are really focused on that.
Yep. And I mean, a natural reaction for us and our organization was, let's go get all the refis that we possibly can. And just recently, as recent as last month, we started to repivot, and we started realizing that every loan officer in the country has abandoned those realtor relationships. So now more than ever, it's easier to establish relationships. Just a loan officer calling, a realtor, no one's even doing it. So as we started to reach out and we were coaching our guys, hey, call these agents, they're getting a great response. And these agents are happy that somebody's picking up the phone to give them a call. So right now, more than ever, is the best time to pivot your business, go back to the purchase market. And looking at those graphs, you can see, I mean, geez, there's still a massive amount. Although it feels like there's no purchases going on and your whole pipeline's filled with refis, it's the exact opposite. And there's more opportunity right now than ever.
Yeah, I totally agree. And what you said, in my mind is there's an opportunity for originators to gain market share with realtors, right? The competitive environment is ripe if you have the right focus to go out and build your business, right? Mm-hmm. So that's really, really exciting. Very exciting. Okay, great stuff, Len. Thank you so much. So I want to delve back into, with Shelby, more of, the impacts, how we're adapting to these market conditions. How are they impacting your business? How are they impacting your organization? So, so really, how are the trends that we've seen this year impacting you? I know you're a big time originator, and then your organization.
Yeah. And I'll try to give everybody as tactical information they can walk away with and try to change their business. Some of the things that we've done is we began breaking down our process into pods because it's easier for us to hire, right? We're all independent mortgage brokers here. We're not massive organizations where we have a training department and a hiring department. So it's really tough for us to be able to catch up. So what I've done within my business is I started hiring people. There's so many people out there, especially if you go after servers, bartenders, people in those types of industries, because they're still off of work. So, and they're personable people. They're used to talking to your clients and people. So what we've done is we go after them, zero industry experience, and we're just training them on one piece. Here's the application. Here's what documents that we need. Help us fill the gaps, communicate with clients. When somebody fills out the application, call and greet them. That's it. Just tell them that we got their application. Here are the missing items. You're going to be there as a resource. And they're packaging this loan up for us. That way, when the loan officer, they're scheduling our calls, loan officer goes in there, they have a complete file. They're able to do that meeting. And then we're teaching our loan officers just to be more efficient with your time. Don't sacrifice your friends. Don't sacrifice your family. Don't mess with your own personal well-being, but just be laser focused when you come in, organize your loans, get back to people, hit those appointments, and that's allowing them to grow their business.
Yeah, efficiency is a big part of it, right? So making those observations and then applying that to different processes is what I'm hearing, and then you're building efficiency and putting the focus on efficiency in the origination world, because the opportunity is just tremendous, right?
Yeah, absolutely.
One other aspect that we're paying a lot of attention to at HomePoint is the impact on, not just the supernova refi boom, right? And all the volume that our support staff is supporting. But it's also, the personal load that everybody's carrying in the COVID environment. What are you doing to kind of connect with the emotional side and really help your employees through a very challenging time?
There's a clear line of communication of, how are you doing? How are you doing? Are you stressed out? Are you too busy? Where are you at? So we're constantly just asking every single team member, where are you at? Are you overloaded? Where could I help you? And, like I mentioned before, we call it overstaffing by design, right? So what we're doing is we're finding key individuals to help support key individuals. We have a loan officer who's extremely busy, then we're getting them some front-end support. If we have a processor that's really busy, same thing. They don't have time to give updates anymore. No more updates. Here is Cindy, and she's going to help you just do updates. So we're hiring key individuals that are around. We all have friends, family members, people that we know that are directly connected to us. We're giving them an opportunity. They're helping us, and we're just focused on little pieces of the business to support our staff. But we're also not allowing people to work all night long. I hear a lot of loan officers, they're almost like bragging about it. Oh my gosh, it's 10 p.m. I'm still in here grinding. And I think that that's the worst possible thing to do, especially when we're not in a sprint. This is a marathon. You're going to get burned out. And, something that we say all the time is how you do one thing is how you do everything. If your personal life is a mess, it's going to end up bleeding over to your business. So take some time, make sure that you're still there for your significant other, you're there for your kids, you still have some time for yourself, because we're in it for the long haul. If you need help, speak up, That's how we're focusing on it.
You guys are HomePoint customers. I mean, it feels like you're part of the organization. There's so many things that you hit on that we've been doing. And thanks to the leadership team here, which really does have a pulse on culture. We really do care about our employees, our associates first. One thing that's worked for us is we have one question survey that goes out to every employee. And it's just basically, how are you doing? What's your stress level, 1 to 5? And then there's a place for them to give their feedback. And that cascades to all layers of management, all the way up to our executive team. And they read all the surveys every day. So it gives you that insight of what your people are really dealing with. And we started that right in mid-March, right when the crisis hit. Another thing that we've done is just give more access, right? I mean, you guys are a smaller organization, but we have over 2,000 associates, and we still see our executive team every week. So I think there's massive opportunity there to engage with our people, to understand what they're dealing with on a personal side, and see how we can help. And I think that level of communication is really, really important. The other thing that I would just say, just to the originators that are on this call, hug your ops people because they're carrying us right now. Obviously, you know, when we talk about capacity, there are only a few aspects of that capacity that's technical, right? You've got technology and the bandwidth that we all struggle with. You have the tech systems and the amount of load that they can carry. And then the financials, we've got limitations from warehousing. But then the other aspect of capacity, the rest of capacity is people, right? And Shelby, to your point, it really does feel like our folks are working 22 hours a day to carry us. So we really do need to make sure that those people are taking the time that they need to finish the race, right? To your point, it's a long distance effort. And thankfully, you know, I'm so thankful to be in this industry, so thankful to have the opportunity that we do when other folks are in a tough spot right now, right? So we're very blessed to have the opportunity that we do. And you know, as Len says, it's going to be here to stay. So this is definitely something where we've got to connect with our folks and make sure that they've got the right approach and we don't get burnt out, because we need everybody to manage the demand that we're seeing, right? So Len, want to kick it back to you as we see the mortgage industry balance this massive pipeline and also prepare for the coming purchase market. What purchase market fundamentals should brokers keep in mind?
Yeah, I mean, I think one thing, you know, our industry has done pretty well for the broad economy. To think about sort of where that sort of first-time buyers are going to come from, and the broad economy, you know, the broader economy, which I think is still, there's a lot of pain there, a lot of people struggling. Fortunately, you know, it seems the economy is starting to pick up some steam and get back on track, and that's going to be really critical, because as we look ahead, there's this tremendous tailwind in the housing market coming from the millennial generation. We've done a lot of research at Freddie. You know, my team, colleagues have been trying to look at that generation and understand sort of home buying attitudes, home buying trends, forces that have affected them. Absolutely, affordability has been a major challenge because of high prices, but given limited supply and fierce demand and low mortgage interest rates, prices are probably going to continue to rise pretty rapidly, which is going to make it a stretch. But nevertheless, even despite all of those challenges, there is just this tremendous tailwind from the absolute just sheer number of you know, millennials, first-time home buyers entering the market. We're seeing a very, very strong volume in Freddie data. That's been expected given the demographics, and as you know, you look ahead, that's probably going to continue for 3 or 4 more years, just given the population. And so, serving that group. Being ready for them, sort of pivoting, as you mentioned, to a purchase market, which is likely going to dominate, you know, 2-3 years out. The demand is going to be there, and understanding that market and making those connections now seems like a prudent practice, because if you think about sort of what's going to dominate the market on mortgage space in 2022, it's going to be those buyers. It's going to be a huge source of potential business opportunities and an opportunity for our industry.
And
Totally.
I think we've been hearing that for a long time, is the millennial buyers, millennial. And, you know, that's something you heard me say earlier was Amazon-like experience for your clients. Mm-hmm. That is where I think that our organization is going to gain some serious headwind, is because we're creating an experience for the borrower through engaging with them on social media. We have a homebuyer university that we do. So when new homebuyers come in to the application, they can watch a series of videos that walk them through the home buying purchase. How do you know you're writing a good offer? How do you buy down your interest rate? What's private mortgage insurance? Everything. And they're on their, you know, themselves, educating themselves. But we want to make a very simple mortgage process, set clear expectations, do video integration throughout the process so they don't have to call us or wait for, you know, us to call them. Streamline the process. So as an originator, just hearing this information, you need to be investing in your business now. Invest in the technology, invest in some new systems, but create an Amazon-like experience. And I know that that's going to have you winning in 2021, 2022, 2023.
That's right. We always talk about trust and certainty of execution, right? That's how you build trust, is through certainty of execution. And so it's great to hear that you're investing in the technology to make a better user experience. Obviously, we're heavily focused on that as well. It's all about improving the efficiency of the organization and how we execute. And that's going to pay dividends in the long run. Love to hear about the investment that you're making in education as well. We've just initiated our futures programs, where we have futures programs and a career path for basically every position at our organization. So that's something that we believe heavily in. The learning and development side is actually it's one of the more exciting things, right? So we have a lot of questions. I'm going to go to the first one for Len. Len, how long can the mortgage industry sustain this level of volume? When do you see things changing?
Yeah, I think that this is a one-time hit, right, in terms of the refi spike. So you saw that sort of in the blue and green bar chart there. That we're going to get a strong volume. It's continuing to run pretty strong here into the fall, and likely, if rates test new record lows, if they were to drift down, we could see that volume even bump even higher. One thing I don't have is in terms of absolute counts, we're not at a record high. So in terms of counts of mortgages, actually 2003 was actually way bigger than 2012 and this year. So in terms of potential, there's still a lot of potential out there. If rates remain low, we could see that extend into next year. And if we tested new lows on rates, we could see even more strong volume. But our anticipation is that isn't going to be the case, that we'll see rates, gradually tick a little bit higher and volume slow down fairly substantially into next year. So that's our baseline forecast with a lot of uncertainty, is that the volumes will continue to run strong throughout most of this year, either later part of this year or early next year, as rates even just drift up a little bit. That'll be enough to, I think, slow the refinance wave. And then we'll be switching over to that purchase wave, but it'll take a while for that to dominate.
Okay, we'll go to the next one. We've got a question for Shelby. Shelby, how do you convince a potential new hire, like a server, bartender, et cetera, to come into a commission-only role? Do you sell them with business already? They're waiting for them to reach out.
Well, the roles that I'm talking about, they're not commission only. They're W-2 employees, just for a very, not a big wage, to tell you the truth. It's usually between like $12 and $15 an hour. And it's something that they can do to supplement their income. They like our work environment. But then we set up a path for them. So like, look, you're going to learn how the operations work and what the industry is all about in this role. And then you're going to graduate into this next role, which is a processing assistant. And then when you become a processor, you can make this kind of money. And in the meantime, you can get your license. And once you get licensed, now you can become an originator, and this is the kind of money that they're making. And we're sharing the information as well of this is a marathon, so if you get in now, 6 months from now, this could change your life. And people are excited for the opportunity. They're excited for something new. They're excited just to get back to work. So, we haven't had any problems. I mean, every person that we've approached, that fits our culture, they're very excited and they're eager to learn.
That's great. I love it. Love hearing about it. So we've got a couple questions for Len. Let's dive into this one. If Fannie and Freddie are privatized, how will that affect the lending industry and or broker wholesale specifically? So don't want to pin you down too hard, Len, but whatever you can say on that topic.
Sure. I mean, a big focus of our executive leadership at Freddie Mac is preparing for an eventual exit to conservatorship, which, could be a form of privatization. The exact details of that are all subject, are unknown, but we're preparing for that. And one of the key objectives of both, organizations is to maintain stability in the mortgage market. I mean, there's a lot of divergent views about, politically about how things should be structured, but I think pretty much everyone is in agreement that having a sustained, stable housing finance system is in everyone's interest, and we want to maintain that. And so I think that any kind of changes are likely to be very gradual and are going to likely try to maintain stability. How that influences particulars of business is hard to say, But in any case, I think that these will be down the line. Nothing I think will happen immediately. I've been at Freddie Mac for over a decade, and we've been talking about it for over a decade. I don't know if it'll be another decade. It could be shorter. We're preparing for that eventuality, but a lot of things got to fall in place. But from the terms of the broader market, I think that we can anticipate that it is very likely that the market's going to be slow, gradual, telegraphed, and market will keep things stable as we can.
Okay, great. Thanks for that. One more for you, Len. How much more MBS will the Fed keep purchasing? And if that faucet turns off, what would the real rates be?
Yeah, so I think there's sort of two components to what was going on. So the Federal Reserve is purchasing a lot of mortgage-backed securities, and that's helped to bring down yields on MBS for sure, and that's benefited borrowers by lowering those rates. I think a lot of the activity was really in March and April when the market was under a lot of stress. It was more of a liquidity event than anything, and so the Fed stepping in there was really instrumental in keeping the market smoothly functioning and helped bring down some spreads. I think now, as you're looking forward, spreads across all different types of securities have sort of normalized. They've gotten back down closer to what we saw before the pandemic. And so I think that if the Fed were to curtail their purchases, that would have an effect. But I don't know how substantial it would be relative to that sort of liquidity shock that we got in the spring when you saw spreads really widen for a number of days, and then the Fed stepped in to tighten that. So our anticipation is that things will be just like with everything else, it'll be gradual, and likely that over time it may lead to slightly higher mortgage rates, but nothing I think imminent.
Okay, I'm going to take one. So we have a question on staffing. So basically, Will, how's Home Point handling staffing as a company? So the challenge that we've seen is just this explosion in demand, and we see it as a tremendous opportunity. We're a very growth-oriented and growth-focused company, and so we made staffing and building that capacity our number one priority. So we really kind of got through the storm in March, kind of figured out what we needed to do about the market. Liquidity came back. We felt really strong, and we went into the market with a message that said, we're ready to staff up big time. And what we found is, there's more to it. It's a very competitive environment, and you've really got to build the infrastructure to acquire the talent that we were looking to acquire at the scale that we're looking to build. So over the course of the next few months, we really kind of honed that skill in, provided the right reporting and visibility, connected the right people into our recruiting machine, and now we're on pace. So we're bringing in a tremendous amount of people every month, and we've also launched futures in underwriting and in closing, so that we're developing talent that wants to be a part of those roles as well. So we feel really good about where we are and where we're headed. And we're building that capacity to sustain the demand. And then eventually what we'll see is we'll be able to deliver better SLAs and better turn times as the staff that we've brought on really gets up to speed. So we're feeling really good about the near and the long-term future from a Home Point perspective. So I took that one. Let's go back to Len. Len, what do you think will happen with the deferred payments in the first quarter of 2021 when they become due? We are hearing that there'll be massive loan modifications.
Yeah, there's a lot of uncertainty around what's going to happen. There were a lot of payment deferral programs put in place to help sort of folks get through an incredibly tough time. They've been extended, and then the real key question is what is going to happen when we get into the spring. Cautious optimism that the broader economy is picking up and that we're seeing sort of employment bounce back. I mean, very, very strong. We've still got millions of Americans that have lost their jobs, but in aggregate, we've seen a significant gain since the spring. So it's really going to depend on what the state of the economy is. But there's no doubt that some folks are going to struggle and it's going to be tough, right? So there's going to be some folks who are going to fall into delinquency and potentially or need for further modifications. Something we're looking at, but a lot of it really just contingent on the economy, and that economy is contingent on the pandemic. And so tremendous uncertainty around what that can be. We could put out a point forecast, but really, when you think about these things, it's better to think through scenarios right? So if there's a scenario where we have good news on the health, vaccine or treatment, and cases rates come down, the economy is going to be a much different place than if we see an uptick in the fall and spike in case rates and the economy contracting again. That could be very tough. So, and both of those are very real possibilities. And you think about sort of the outcome for borrowers would be very different in those. So I think that's something that we're looking at and thinking through. But to put say right in the middle, we're not likely to be in the middle, but that's where your an average estimate would be, isn't so helpful. So it's broadly think about the broad scenarios. But there's no doubt that folks are still struggling. There's still a lot of challenge in the economy, and that some folks are going to need some continued help and assistance to make it through as we get into next year.
Yeah, absolutely. For Shelby and Will. So Shelby, I'll let you lead this one, and then I'll come behind you. With the overwhelming amount of refi business not looking to drop for a few months, how do you focus on purchase business and strategic partnerships with realtors? Do you set aside a specific amount of time each day? Do you assign specific resources to perform outreach? Do you forego refi business to pursue purchase business, i.e. leave money on the table for longer term success? I think that's a great question.
Yeah, that is a really good question. So I think that you do a little bit of all of those things. If as an originator, if you can afford to hire somebody, at an hourly wage or an assistant or your wife or your brother or anyone that can help you, then what you're going to be doing is you're going to be coming up with a list of people that you're trying to go after, or even realtors that are on the other end of your current purchases. Do a phenomenal job updating them. They're not used to that right now. So by you updating the listing agent, nobody has time to update the listing agent right now. So by the fact that you're actually taking the time to do that, their mind is blown. They're like, oh my gosh, I need you right now, because my regular loan officer is not even calling me for updates at all. And you're on the other side of a transaction. You're doing a phenomenal job. So we're focused on that. We're also focused on new relationships. And, some loan officers have a loan officer assistant that's calling and establishing those relationships. And then also setting time aside every day, every day, follow up with all those realtors that are in your database, letting them know that you care. Even if it's just a simple, how are you doing? Is there anything I can do to support your business? I think that those are super important, but that's how we're attacking it.
Yeah. Yeah. From our perspective, we love purchase business. It's how I was brought up in the business, is to understand purchase execution, service execution, the ability to deliver on a good customer experience and, gain and maintain the trust of a realtor or a builder is really kind of where you hang your hat. And we absolutely feel that way here at Home Point. Even though 2/3 of the opportunity in the market, 2/3 of the volume, as Len showed us, this year is refinance. We really feel like we want to deliver and design a process and an experience that is reliable, that enables us to earn our customers' trust every loan that we do. And so we do deliver better turn time or a condensed turn time for purchase loans. We'll always do that where they're prioritized from a decision standpoint. And we do everything that we can to hit purchase closing dates so that, we make our customers look good and so that they can trust us with that next loan. So we're never going to stop focusing on purchase business despite the current opportunity that exists in refi. We're always going to hang our hat on purchase execution.
One other thing that I forgot to mention was in a regular market, we're trying to improve people's credit. We're taking on any deal that we can. Somebody comes to us with a 203K loan and we're like, okay, down payment assistance, the subordination, those types of loans. We're just being super upfront with the borrower, and we're almost making the borrower do a lot of legwork to put us into that situation. So we're not taking on every deal. If there's a hard deal, I'm not going to take it on. I'm not going to perform the rapid rescore and coach them through how to improve their credit. I'm going to tell them, hey, this is what I need you to do. We're going to wait this out. When your score improves, come back to me. I'm not going to take on a lot of those hard deals. I'm going to take on the deals of people that are really ready to go. I'm making them gather all of their documents, really setting up the loan. And if they're motivated, we're moving forward. I'm not chasing people down. And that's really helped us navigate and create more time. You know, more deals are going to be coming in. So even if your pipeline's running a little dry, that's okay. They're going to come in. So just trust the process, focus on realtor relationships, focus on the refis, don't abandon them, but just be smart.
That's the efficiency bias, right? And the discipline. You know, we're hearing the discipline that's required to kind of adhere to that and to gain the efficiency that you need to gain in this market to take true opportunity, take full advantage of the opportunity. So Len, can you speak to the FHFA 50 basis point hit to refinances? Do you feel like that's going to have an impact on volume as that plays out?
Yeah, so, you know, as we mentioned, there are some losses that are going to be associated from the mortgage, credit side eventually due to the pandemic. And because of the higher anticipated losses, the FHFA in concert with the GSEs did tack on the adverse market fee. And it was delayed until December, recognition trying to keep the pipelines, not adversely affect those. But that fee was meant to help cover some of those anticipated credit related losses. How much of that effect that's going to have on the broader market, I don't think it's going to have a huge effect, because this as an upfront fee is not going to translate to 50 basis point higher rate that the borrower pays. It might be something closer to, say, 10 basis points, maybe, perhaps, which is not zero, but is not a huge significant given the fact that rates have moved around way more than that on a week-to-week variation. So while it may lead to a slightly fewer transactions, not a huge amount. And so there's still tremendous opportunity in the marketplace. There's still a lot of borrowers who have potential to refi. One thing I didn't mention was, though we've seen very, very strong refinance volumes, if you actually just look at the outstanding pool of mortgages, the number of borrowers who potentially could refinance given the market rates, even if they were 10 basis points higher, is still somewhere around 30 to 40% of outstanding mortgages. So there's still a absolutely tremendous opportunity, and if rates remain pretty low throughout the fall and into winter, there's still a lot of opportunity there in terms of volume.
Yeah, great. Thank you so much. Shelby, can you please go into a little bit more detail about your concept of pods? Sounds interesting. Thank you.
Yeah. So basically what we do is we have a front end pod, a pod in the middle where our processors are, and then we have our closing pod. So the front end pod, we use a system called Flowify. So the borrower fills out the application. The guys on the front end pod are brand new. They have no industry knowledge at all. But when they see a new application come in the Flowify account, their job is to reach out to the client, let them know, thank you so much for applying. We look forward to helping you. We're setting the whole precedence for everything and saying, obviously, we're very busy. These are the things that I can help you on. Here's a checklist of items that we need. And they're just following up with them every day. And, when it comes to systems, everything is already dialed in. They already know on day one, you're going to text them this message. On day two, if they still haven't responded, you're going to call them, email them, and text them. On day 5, so they're just following the protocol that anyone can learn. And that's the front end pod. And then they have a team lead up front. So once they get done with that and they schedule the call with the loan officer, if they have any questions about anything in the process, they have their team lead. In the middle, this is where our setup team is. They're doing registrations. We do a video up front of the loan estimate. So the loan estimate goes out. We're doing a customized video for the borrower so they can follow the steps. Again, we're setting a follow-up call with the loan officer to go over the rates. And then they have a team lead in that pod. And then our closer, there's really just one closer per team. And they're setting up the signings, making sure that everybody's informed, making sure that the borrower knows the process, that they're at ease. They know that the loan officer is not showing up to signing, all of that. So that's how we manage those pods, and it's set up based on production. But that's what we've done to help scale. Because me as an independent mortgage broker, if I went out and tried to recruit a processor right now that has experience, there's no chance. It's not going to happen. So that's what we've done.
It. I love it.
Yeah, and
That's
it's working out better.
That's awesome. So I think we're actually over time, but let's take one more just for fun. Len, how do you think the election will play a role in interest rates?
Fun. Yeah, no, this one's hard. Politically, I play economist. Playing political scientist is beyond my skill. I don't know how to handicap what's going to happen. A lot of uncertainty. And then what's the impact going to be on rates? Almost impossible to say. We saw after the 2016 election, which was a surprise to many, interest rates initially sort of moved one way and then very quickly turned around and moved the other way. So in terms of what it could do, I think the one fact is if there were a surprise or even no surprise, we could see a lot of volatility. So I would anticipate that the potential for rates to move pretty significantly, leading up to or around that is pretty high. But over the long term, I don't think it'll have a long-term effect there until you start getting into budgets or tax policy or other things that would affect the broader economy. So the news will probably move things, but over, after we get to December, I would anticipate rates to be pretty much similar under either, election outcome.
Yeah, short-term volatility is what we should expect, right? Great, guys. I really appreciate the dialogue today and the insights. Thank you so much for joining us, and thanks to our audience. Great questions. Really appreciate you guys tuning in for our first episode, and look forward to engaging with you guys in the future. So, thanks. Have a great day, and appreciate the participation, guys.